When we talk about the financial markets, we usually use clinical terms. We talk about alphanumeric tickers, algorithmic trading patterns, and complex candlestick charts. But viewing Wall Street strictly through this mathematical lens hides the most unpredictable variable in the entire global economy: human psychology. That sterile illusion of control shatters the moment you realize logic doesn't drive short-term market fluctuations. Raw, unfiltered emotion does. So what happens if we imagine investors as actual animals? Welcome to the stock market zoo. In this ecosystem, the everyday retail investor is the rookie rabbit, agile and eager to build wealth, but highly vulnerable to sudden shifts. The rabbit is surrounded by heavy hitters, massive bulls charging forward during times of economic expansion, and lumbering bears dominating the landscape during systemic declines. But the real danger here doesn't come from the bulls or the bears. It comes from two omnipresent, invisible beasts: fear and greed. And this chaotic zoo is not confined to a few elite trading floors. According to data from the Federal Reserve, the capital markets are now deeply woven into American household finance. Today, over 76 million U.S. households actively participate in the market. We are talking about the retirement accounts and college savings plans of millions of average, hard-working citizens. When the rookie rabbit enters this high-stakes environment, perhaps by downloading a sleek, zero-commission mobile trading app, they step into a psychological trap known as overconfidence bias. The modern abundance of charts and news feeds tricks new investors into believing they have an informational edge. They dramatically overestimate their ability to predict chaotic outcomes, assuming they can routinely outsmart heavily resourced professional market participants. Democratizing the market successfully tore down traditional financial barriers to entry, which is a massive achievement. But it did so without a corresponding increase in financial literacy. We essentially invited 76 million households into the zoo, exposing them to hyperactive, highly emotional trading without giving them the defensive armor needed to survive the stampede. Deep within this volatile ecosystem, the single most destructive behavioral pattern is the herd mentality. In the wild, staying tightly packed with the flock keeps sheep safe from predators. But in the modern capital markets, blindly following the crowd mathematically guarantees that you will buy an asset at its absolute peak valuation and panic sell it at the lowest possible price. This is driven by the fear of missing out, or FOMO, a psychological contagion where an investor aggressively buys a rapidly escalating asset simply because everyone else is visibly profiting. Today, this flock of sheep doesn't gather in physical investment clubs. They congregate in digital echo chambers. Unregulated social media personalities, often called finfluencers, have become the de facto leaders of the herd. Younger, inexperienced investors increasingly use these unverified video channels as their primary source for critical capital allocation decisions. This is a bar chart from the FINRA Investor Education Foundation, comparing the self-reported confidence of social media investors against their actual objective knowledge. Notice this massive gap. While 63 to 66% of finfluencer followers claim to have extremely high subjective knowledge about the markets, they score significantly lower on actual standardized investment tests when compared to investors who don't rely on social media. It is a highly combustible mix of false confidence and low factual knowledge. That exact combination makes the digital herd the perfect target for opportunistic fraud. The data shows that social media users experience substantially higher rates of direct financial victimization. When targeted by complex investment scams, nearly 70% of finfluencer followers actually lose their money. And the primary conduit for this wealth destruction? Visual platforms, leading with a devastating 79% loss rate tied directly to YouTube. When you enter a highly speculative position just because an influencer's audience is doing it, you abandon thorough due diligence and proper fundamental valuation. You effectively outsource your personal risk management to a faceless, emotionally volatile mob that will absolutely not protect you when the inevitable panic hits. To understand why these panics are so violent, we have to look at a core behavioral concept detailed by Nobel laureate Daniel Kahneman: loss aversion. This is the proven psychological principle that human beings physically and emotionally feel the pain of a financial loss far more intensely than they experience the joy of an equivalent financial gain. Because losing money is neurologically agonizing, the sudden appearance of the fear beast triggers a disproportionate response. When portfolio values drop, the emotional pain quickly becomes unbearable for the rookie rabbit. Take October 2008, the peak of the systemic financial crisis. Rather than holding firm and waiting for the eventual recovery, terrified retail investors aggressively liquidated their massive positions at the absolute bottom of the market, engaging in chaotic panic selling just to escape the immediate psychological discomfort. This is a dual-line graph from the Dalbar Quantitative Analysis of Investor Behavior report, explicitly tracking 30 years of market returns. The top line shows the benchmark S&P 500, achieving a steady annualized growth of 10.16%. But look at the bottom line, the average equity retail investor, constantly jumping in and out of the market based on fear and greed, captured less than 4% per year. Let's translate that abstract percentage gap into hard dollars. Over a standard 20-year investing timeline, an initial investment of $100,000, subjected to continuous emotional interference and frequent mistimed trading, results in an unrecoverable deficit of over $134,000 in lost potential wealth. That massive six-figure loss is the exact mathematical cost of trying to guess the market's direction. The math from the last few decades proves a highly sobering reality. The active, emotionally driven investor attempting to perfectly time their entry and exit points is mathematically and consistently beaten by the passive, emotionless buy and hold investor. Understanding the psychology of the zoo is only the first step. To actually survive, you have to acknowledge that human beings cannot biologically suppress evolutionary fear and greed through pure mental willpower alone. Instead, you must build rigid, physical structural defenses within your portfolio that completely remove the opportunity for manual emotional interference. This flowchart illustrates the single most effective mathematical weapon against extreme market volatility, dollar cost averaging, or DCA. By committing to automatically invest a fixed dollar amount at regular intervals, you force a distinct mathematical advantage. You systematically buy more shares when prices are depressed and fewer shares when prices are highly inflated. Because the purchases happen automatically on a set schedule, you don't have to consciously battle the greed beast during an irrational rally or the fear beast during a terrifying downturn. Alongside automation, you need strict asset allocation. Spreading your capital deeply across highly diverse asset classes acts as a critical shock absorber, heavily cushioning your portfolio against catastrophic losses in any single sector. Couple that diversification with an extended time horizon. Volatility is fierce over short periods, but as your investment timeline stretches across multiple decades, the violent daily noise of the zoo naturally smooths out, allowing the immense power of compounding interest to work uninterrupted. You must also actively sever your reliance on unverified digital echo chambers. The heavy dependence on unregulated social media for financial advice is a primary vector for targeted wealth destruction. Instead, seriously consider utilizing a legally bound professional fiduciary advisor. A registered advisor acts as a highly rational emotional filter, actively sounding the alarm when you propose a knee-jerk reaction to a fleeting geopolitical event. The broader macroeconomic environment, from interest rates to corporate earnings, will always be completely outside of your personal control, but your internal behavioral response to that environment is entirely within it. True long-term generational wealth creation doesn't require the impossible task of perfectly predicting global economics. It simply requires implementing the quiet, automated systems necessary to master yourself.